Russia's economy is doing the unthinkable, staying afloat, perhaps even growing, despite years of war and punishing sanctions. How? Is this sustainable or a ticking economic time bomb? Here's the million-dollar question. How much longer can war prop up Russia's economy? In this video, we'll peel back the curtain on the so-called war economy, a model propped up by relentless military spending, fiscal stimulus, and state control. You'll discover why Russia's GDP defied expectations with 3.6% growth in 2023 and nearly 4% in 2024, despite global isolation. How the Kremlin has built a dual-track economy, where defense booms while the civilian sector collapses under inflation and underinvestment. Why analysts warn this fragile model may only persist another few years due to squeezed oil revenues, depleted reserves, labor shortages, and mounting inflation. Stay with me as we break down the mechanics, dangers, and ultimate limits of this war-driven economic strategy. Let's dive in. War as an economic engine, turning economy into arsenal. Since the full-scale invasion began, the Kremlin has transformed Russia into a war-driven economic engine. Defense now takes up roughly 6 to 7% of GDP and possibly a staggering 40% of total government spending. Massive fiscal stimulus, pension supplements, military bonuses, defense procurement, tax relief has pumped over 10% of GDP into the economy between 2022 to 2024. The result? GDP growth of around 4% in 2024, defying Western expectations that sanctions would cripple the economy. The economy of death, a chilling term coined by Le Monde, captures how lucrative enlistment, bonuses, and death subsidies have fueled local booms in poorer regions. Putin has effectively overwritten civilian economic logic, prioritizing arms and war-related sectors, even at the cost of healthcare, education, and civilian industry. Cracks in the armor. Fragility behind the facade. Despite the facade of resilience, key vulnerabilities are emerging. 1. Falling oil and gas revenues. Oil and gas income dropped by 27% year-on-year in July 2025 as price caps and sanctions bite. The loss of key buyers like India due to U.S. tariffs poses further risk. 2. Fiscal strain and drained reserves. Russia has tapped into its national wealth fund extensively, over $38 billion in early 2023 and more continuing through 2024. Experts project that without a turnaround, by 2026 to 2027, these fiscal strains could trigger a crisis. 3. Inflation, interest rates, and labor shortages. Inflation surpassed 9 to 10%, with perceived inflation felt by households closer to 16 to 21%. In response, Russia's central bank hiked interest rates to 21%, stifling investment and growth. Labor shortages abound, especially as workers flee to military production and skilled professionals emigrate. 4. Overdependence on war economy. The civilian sector is collapsing. Many industries are unprofitable or shuttered. Small businesses have plummeted by over 40%. The arms sector has become deeply embedded, employing millions and making unwinding militarization politically and socially dangerous. Bottom line, Russia's war-driven economic model is narrow, brittle, and increasingly unsustainable. Cracks. Widening. Economic pressure. Mounts. First, declining oil and gas windfall. Oil and gas revenues fell sharply, 27% year-on-year in July 2025, down to roughly $9.8 billion. This decline is aggravated by recently tightened EU price caps tied to market rates and US secondary sanctions targeting big buyers like India. If Indian and Chinese imports drop further under pressure, fossil fuel revenues could collapse, deepening the economic crisis. 2. Internal headwinds, recession on the horizon. Growth is sputtering. GDP growth slowed to just 1.4% in early 2025, down from 4.5% in late 2024, while inflation eased from 8.2% to 4.8% between Q1 and Q2. It's come at the cost of even slower growth. Manufacturing and services are contracting sharply, while companies across sectors feel stress under high interest rates and squeezed demand. 3. Costly military incentives and labor frictions. Moscow has more than doubled recruitment bonuses, now around 400,000 rubles, nearly 5 times the average monthly wage. These subsidies fueled short-term GDP but sparked inflation and severe labor competition between military and civilian sectors. Economists warn that this model is unsustainable, especially amid ongoing high casualty rates, unless Russia moves to involuntary mobilization. Fourth end of the war economic boom. What economists dub the sugar high from wartime stimulus is fading fast. The economy is entering a stagflationary phase, stagnation plus inflation with dwindling reserves. At the St. Petersburg International Economic Forum, even the economy minister admitted Russia is teetering on the edge of a recession, a rare public acknowledgement of growing instability. Expert forecasts and strategic implications. 1. Putin commits to prolonged militarization. Despite faltering civilian growth, military spending remains inviolable, projected at $172 billion, 7.7% of GDP, through 2027. Putin personally drives this militarization, seeing it as a long-term strategic imperative, regardless of the war's timeline. 2. The tipping point. 2026 to 2027. Key forecasts converge. Barring meaningful reforms or dramatic changes, Russia's war economy likely reaches its limit by 2026 to 2027, when reserves run dry and economic pressures become untenable. Without stronger sanctions, the Kremlin may hold on, but not much longer. 3. Structural weaknesses beneath the surface. Experts highlight Russia's dual economy. A government-backed military sector versus a collapsing civilian economy. A collapse masked by defense-driven growth. With export markets shrinking, sanctions evasion costs rising, and poor labor and migration policies, the model is teetering. The war has also devastated long-term business prospects and growth potential, issues that persist even after sanctions are lifted. How much longer? The outlook. War economy on life support? Experts offer a cautious timeline. Next 1 to 2 years. Outlook. Continuation possible if sanctions hold steady and stimulus continues. Timeline. 2026 to 2027. Outlook. Major inflection point. Reserves depleted, oil revenues dwindling, military overreach unsustainable. Timeline. Worst case. Outlook. If Western pressure intensifies, especially via tighter sanctions on oil energy, Russia could face systemic collapse or force de-escalation earlier. Scenario breakdowns. Status quo sanctions. Russia sustains war economy for 3+ years, but with declining performance and growth. Further sanctions reinforcement, particularly energy-based, accelerated economic decline, raising prospects of internal pressure to end war sooner. Partial sanctions relief or peace could reset economy, but highly unlikely unless geopolitical dynamics shift dramatically. In short, Russia may limp along until 2026 to 2027, but the economic engine powering its war appears to be slowing down fast. The sanctions evasion lifeline and its fragility. One reason Russia's war economy has lasted this long is its reliance on shadow trade networks, complex webs of intermediaries, ghost companies, and friendly states that help Moscow bypass sanctions. Key players include countries in the Caucasus, Central Asia, and parts of the Middle East, which have become re-export hubs for sanctioned goods like microchips, machinery, and dual-use technology. This parallel supply chain has kept defense production running even when direct imports from the EU or US dried up. But the cracks are visible. Western governments are now expanding secondary sanctions, punishing not just Russia, but also the intermediaries that help it evade trade restrictions. In early 2025, several Central Asian firms were blacklisted for funneling sensitive tech to Russian defense plants, disrupting shipments and raising costs. Experts warn that if these secondary sanctions intensify, Russia's military-industrial complex could face critical shortages within months, not years. In short, Moscow's economic survival depends not just on oil revenues, but on the resilience of these shadow routes, a lifeline that's becoming harder, riskier, and costlier to maintain. What if war ends? Then what? From war machine to economic collapse or rebirth? If hostilities cease or de-escalate, Russia faces a new set of challenges: demographic and human capital losses, SMEs down 40%, skilled workers migrated, undermine long-term recovery, huge fiscal liabilities, veterans payments, debt, possible reparations, replacement of lost production. Sanctions may ease slowly, but investor confidence and foreign capital are lagging. Alternatively, a well-managed peace and economic pivot could revive civilian sectors, but would require sweeping structural reforms, diversification, and trust rebuilding, something currently far from the Kremlin's agenda. So, how much longer can war prop up Russia's economy? The short answer: perhaps a few more years, but not much beyond that. The war-driven growth has been real, but fragile. Oil revenues, stimulus reserves, and deferred civilian collapse have masked the deep cracks. Without major change, from sanctions, from strategy, or from the Kremlin, Russia may hit an economic breaking point by 2026 to 2027. Want to stay ahead of these developments as policy, markets, and geopolitics evolve? Hit like, subscribe, and ring that bell so you don't miss a beat. And please share this video, because understanding how war, economics, and politics intertwine isn't just fascinating, it's essential.